Donald Trump has told a rally at a U.S. steel plant in Pennsylvania that he intends to double U.S. steel import tariffs to 50%.
A large-scale aluminium smelter in Quebec has just announced an investment of up to $1.5 billion, backed by a new long-term power agreement with Hydro-Quebec. This marks an ambitious step for Rio Tinto, as the company pushes forward with one of the biggest expansion projects in the history of aluminium production in Canada, a project drawing attention not only at home, but also worldwide. According to initial reporting from Bloomberg, south of the border, former President Donald Trump appeared at a rally in Pennsylvania, held on the grounds of a steel plant. He shocked many by declaring that he would raise steel import tariffs from 25% to 50% overnight. The announcement sent shockwaves through the aluminium market. Prices in the U.S. Midwest jumped 54%, hitting a new record of $1,325 per ton, as Trump's Section 232 tariffs officially doubled. Canada was quick to respond. The federal government in Ottawa sped up the $1.5 billion smelter upgrade project while preparing to redirect more than 3 million tons of aluminium to European and Asian markets. This left us factories struggling to secure supplies. While America's auto and aerospace industries faced rising costs, European and Asian companies moved fast, locking in long-term contracts and buying Canadian aluminium at pre-tariff prices. The result, the United States was forced into a defensive position while other nations secured better deals. From the energy-hungry smelters in Montreal to processing plants as far as Shanghai, Canada's new strategy is sending ripples across the world. The question now is how a $1.50 billion investment could shift the balance of global trade, reshape tariffs, influence energy markets, and change the way supply chains work in the years ahead. It all began on July 2, 2025. When Aluminaire Awet announced a multi-billion-dollar upgrade to its Septiel smelter, aimed at strengthening North America's aluminium supply. In just a few months, starting in May 2025, U.S. aluminium prices skyrocketed from $860 to $1,323 per ton, a jump of more than 54% after the Trump administration imposed new import tariffs. The Septiel's plant, which employs around 900 workers, produces 620,000 tons of primary aluminium every year. With its new long-term power deal with Hydro-Quebec, the facility not only secures cheap, steady electricity, but also gains a powerful advantage as a producer of low-carbon aluminium, a commodity that's in high demand worldwide. In business circles, the buzz is clear. Low-carbon aluminium from Quebec can be up to 20% cheaper than similar products in the U.S. In Europe, negotiators in Brussels have already rushed to update side agreements, making sure they get access to Canadian aluminium before U.S. prices climb even higher. For American automakers and aerospace giants, the choice is painful. Either absorb higher costs for raw materials or rely more heavily on Canadian imports. Both options bring problems: slower production schedules or more expensive cars and planes. Meanwhile, Ottawa is taking full advantage. By proving it can redirect supply chains, Canada has gained unexpected leverage in global talks, especially in areas like electric vehicle incentives and green energy support. Across the Pacific, Asian smelters that once relied on bauxite are now turning to Quebec, with some even shifting investments into the Canadian market. This shift is strengthening Canada's role in Europe and Asia, while U.S. companies struggle under Trump's tariff pressure. Even the energy sector is now caught in the ripple effect. Petrochemical plants are watching aluminium price swings as a new benchmark for their own costs, closely tracking the market to predict future trends. If aluminium prices keep rising, fears of inflation could return, pushing central banks to rethink monetary policy. What started as a U.S. attempt to protect its industry has now turned into a weapon of foreign policy. Ottawa is proving that economic strength can also become geopolitical power. As summer ends and autumn approaches, the world is left asking, just how far will Canada's $1.5 billion gamble reach? The international community is closely watching the upcoming strategic economic partnership talks to see whether Canada's supply chain shift will be strong enough to reshape the global metals market, ushering in a new era of tariff wars and trade battles. The reality is that right after Ottawa unveiled its massive investment package, U.S. buyers felt the pressure. On June 5, 2025, aluminium prices in the U.S. spiked 54%, reaching $58 per pound. This exposed the true cost of the 50% tariff Trump had signed into law just a day earlier. As of 2023, about 44% of U.S. aluminium imports came directly from Canada, making these tariffs a direct threat to the entire American supply chain. That same afternoon, south of the border, Canada's Industry Minister, Melanie Joly, urgently called a meeting. She condemned the tariffs as unreasonable and unlawful, and declared that Ottawa would act immediately. In the short term, the government promised financial support for smelters like Rio Tinto, while also beginning bilateral negotiations. But experts warned, if the tariffs stayed in place past the July 21st deadline, many small smelters could face severe cash flow problems, leading to mass layoffs in communities that depend on the industry. On the Toronto Stock Exchange, futures prices climbed from 0.2% to 2% by July 7th, as investors weighed the impact of overlapping retaliation measures and a growing climate of uncertainty. Ottawa is now expected to formally strike back with reciprocal tariffs on July 21st. Under the plan, Canada will apply tariff rate quotas on imports from non-FTA countries, fixed at 100% of the 2024 import volume by June 30, 2025. The reciprocity principle in government procurement will also come into effect, further escalating trade tensions. To help businesses survive the storm, Ottawa has announced a $10 billion package of concessional loans and tax breaks for eligible companies. This multi-layered plan is designed to stabilize Canada's domestic metals market, even as rising costs in the U.S. threaten automotive and aerospace supply chains. Looking ahead, Canada is now treating aluminium as a national strategic resource. The government has confirmed that domestic aluminium will be reserved for defense projects and critical infrastructure. This policy shift was officially announced at the North American Aluminium Summit in Montreal on June 2, 2025. But this is about more than just protecting Canadian jobs. By using its clean hydroelectric power, Canada is producing aluminium that's more attractive to tariff-free markets in Europe and Asia. The ripple effect even extends into energy. Because aluminium smelters consume massive electricity, moving more production into Canada lowers oil demand in the U.S. Midwest, reshaping energy consumption patterns across the region. At the heart of Ottawa's three-phase strategy is the transformation of tariffs into a strategic weapon, not just a tit-for-tat reaction to the U.S. Instead, tariffs are being used to strengthen resilience and expand Canada's diplomatic power. It's worth noting, this policy shift is not only about producing more metals. In May 2025, Canada's exports to markets outside the United States rose 5.7%, hitting a record $60.81 billion. The scale of this number is important. It shows a major shift in how Canadian goods are consumed worldwide. For example, gold exports to the UK jumped 30.1%, making the metal one of the fastest-growing commodities. At the same time, Canadian crude oil found new buyers in Singapore. Pork exports to Japan rose, and pharmaceutical shipments to Italy recorded strong growth. These new trade flows partly offset the decline in exports to the U.S., helping the Canadian economy avoid a deeper downturn. Behind the scenes, many small and medium-sized businesses are taking advantage of trade deals like CETA and CPTPP to expand into new markets. From specialized pharmaceutical firms in Quebec to even mascot costume workshops in British Columbia, Canadian companies are finding new export paths. By tapping into tariff preferences, they are steadily reducing dependence on the U.S. market. This sharp pivot not only shields the domestic economy, but also sends a clear message. Canada will not allow itself to be trapped in Washington's tariff spiral. By widening its global customer base, Ottawa is protecting a critical industry, strengthening its leverage at the negotiating table, and reducing its vulnerability to U.S. economic pressure. In contrast, many American manufacturers remain stuck under the weight of 50% tariffs on steel. In aluminium, they now face a tough choice: either absorb skyrocketing costs or source supplies from distant markets, risking long delays, threatening disruption across entire production lines. European and Asian buyers quickly locked in Canadian metals contracts at pre-tariff prices. Washington's policy is now at risk of backfiring. This trade shift not only secures Canadian jobs, but also strengthens the country's reputation as a reliable global supplier. The big question for the next phase is this: can the United States stop Canada's diversification drive, or will it keep losing market share as U.S. factories are forced to scale back? Canada's green technology hubs are rising as front. On July 2, 2025, S&P Global reported that Canada's manufacturing PMI fell to 45.6, marking the fifth straight month of contraction. This showed the heavy damage from Trump's 50% tariff. The new export orders index also sank to 40.2, its lowest level since May 2020, a clear signal of collapsing cross-border demand. Even so, Canada kept moving forward. In Ontario, several electric vehicle battery plants secured new funding. In Manitoba, hydroelectric projects accelerated, attracting clean energy investors eager to bypass U.S. trade barriers. In 2023, Canada's aerospace sector exported more than $19 billion in aircraft and parts, playing a critical role in diversification and global competitiveness. Meanwhile, Quebec has been allocating over $700 million a year to research and development, backing innovation hubs in Montreal, Saguenay, and Est. These investments have advanced flight simulation technologies, new composite materials, and sustainable aviation fuel research, safeguarding thousands of high-tech jobs from possible cutbacks. These adjustments have not gone unnoticed. Both Brussels and Tokyo are scrambling to secure Canadian aluminium deals at favorable rates. By late May, European firms rushed to sign contracts before US-driven price hikes, and soon after, Asian plants followed suit. Breaking away from their reliance on American bauxite today, aluminium shipments from Quebec flow steadily, powered by low-carbon hydro systems and long-term agreements with Hydro-Quebec. This ensures stable energy costs and predictable supply. For us, auto and aerospace industries, the choice is grim. Pay sky-high prices or deal with complex import routes that drive up costs and delay production. From cars to airplanes, there is no easy solution. Meanwhile, Canada's green energy strategy is no longer just smart business. It has become a powerful tool of foreign policy. As summer winds down and autumn approaches, the world's eyes are fixed on smelters and factories, stretching from Toronto to Tokyo. Canada's current course is not just trade strategy, it's a bold, high-stakes gamble that could reshape tariffs, supply chains, and trade battles for years ahead. Pressure from the new U.S. tariff policy has already pushed Ottawa to speed up upgrades at the port of Saguenay. By May 2025, the two deepwater terminals at Duncan and Marcel Dion Quays were ready to handle vessels of more than 69,000 tons. A modern rail system now links Quebec smelters directly to global shipping routes, completely bypassing U.S. territory. In 2023 alone, the port handled over 718,600 tons of cargo, solidifying its role as a key global trade hub. This new export corridor shortens delivery times and allows European buyers to secure Canadian aluminium at pre-tariff prices. New cold storage units and intermodal yards also meet Europe's strict low-carbon standards when U.S. metal premiums spiked 54% in June 2025. Traders from Brussels to Tokyo quickly turned to Canada, while U.S. automakers could only watch as competitors grabbed Canadian aluminium through faster, cheaper supply routes. At home, the impacts have been clear. Communities along the port and rail corridor have gained new jobs, and environmental groups voiced strong support as the port introduced electric cranes and cut down truck congestion. This modernization proves how smart logistics can act as a shield against global political volatility. As peak shipping season approaches, cranes in northern Canada work non-stop. This transformation is forcing all of North America to rethink how supply chains are built. With its green port strategy, Canada is not just talking, it is actively rewriting the rules of tariffs and trade. The country has flipped Trump's 50% tariffs on their head, while avoiding nearly $30 billion in retaliatory costs. From the expansion of the all-wet smelter to the new export model, Canada is proving that green technology and modern logistics can redefine an entire industry. But the question remains, can Canada keep up this momentum in the next trade war? Will Washington strike back with new tariffs, or will Ottawa's bold strategy hold firm?